Are you ready to dive into the intricate world of mergers and acquisitions? In this video, we're breaking down how to strategically identify the perfect acquisition target step by step. And make sure you stick around because I'll be sharing a bonus tip at the end that could give you a significant edge in your next M&A deal. I'll reveal a little known strategy at the end that top M&A professionals use to identify high potential targets before anyone else. Let's start with then the basics of target identification and the approach. From the buy side, with a well-defined strategy in place, companies, often with the support of experienced financial advisors, embark on the meticulous process of identifying potential acquisition targets. This process isn't just about finding any company, it's about finding the right company, one that aligns perfectly with the buyer's strategic goals, financial criteria, and cultural values. The target identification process from the buy-side perspective is both strategic and methodical. It involves a comprehensive approach to ensure that every potential target is evaluated based on a robust set of criteria, ensuring alignment with the buying company's long-term objectives. Let's break down the key activities involved. Firstly, defining strategic objectives. Here, the management role, taking the first step in any successful acquisition, is to understand why you're making the acquisition in the first place. Management needs to clearly outline the strategic goals that drive the acquisition. These could include market expansion into new geographies, diversifying the company's product or service offerings, acquiring cutting technology or highly skilled talent, achieving economies of scale, or enhancing the company's competitive position within the industry. Suppose your company is looking to expand its presence in the European market. The strategic objective here might be to acquire a company that already has a strong market share in that region, reducing the barriers to entry and allowing for quicker market penetration. Financial advisors play a critical role in this phase by helping to redefine these strategic objectives. Their external perspective ensures that the objectives are not only clear, but also achievable within the current market context. They might also align the objectives with the company's broader business strategy, ensuring a cohesive approach to growth. Next comes developing acquisition criteria. Once the strategic objectives are clear, the next step is to develop specific criteria for potential targets. This involves setting parameters such as the industry sector the target should operate in, the geographic location, the size of the company in terms of revenue and profitability, its market share, and most importantly, its cultural compatibility with your company. If the strategic goal is to acquire new technology, the criteria might focus on companies that have strong R&D capabilities, a portfolio of patents, and a culture of innovation. Advisors bring market insights and financial expertise to this step. They help management set realistic acquisition criteria, including valuation ranges and key financial health indicators. For instance, they might recommend focusing on companies with a certain EBITDA margin or those that have a sustainable growth trajectory. We then look at the conducting of market research. With the criteria set, management can leverage internal resources to begin identifying potential targets. This involves understanding the landscape of potential targets within defined criteria. The research might include competitors, suppliers, customers, or other players in the industry that could present a strategic fit. If you're looking to enter a new market, you might start by identifying the top competitors in that market and then narrow down the list based on which companies have the most innovative or have the best customer satisfaction ratings. Advisors add depth to this research by utilizing databases, industry reports, and their professional networks to conduct a comprehensive market scan. They might identify companies that fit the acquisition criteria but are not on your radar due to their smaller size or private ownership. Next, we look at the initial screening. The list of potential targets generated from the market research needs to be reviewed to identify those that warrant further investigation. This initial screening is based on strategic fit and preliminary financial metrics. At this stage, management is looking for targets that not only fit the acquisition criteria, but also have the potential to add significant value to the company. If a company shows strong financials but operates in a declining market, it might be eliminated from the list unless there's a very good strategic reason to consider it. Advisors use financial models and industry benchmarks to assess the viability and value creation potential of each identified target. This could involve looking at revenue trends, profitability, and potential for synergy. They help narrow down the list to the most promising candidates, ensuring that only the best targets move to the next stage. This next stage is the in-depth analysis. The shortlisted targets now undergo a deeper dive to understand their business models, competitive advantages, market positioning, and potential synergies with the buying company. This analysis helps to identify whether the target can identify the strategic benefits that the management is seeking. If a target company has a strong market share but relies heavily on a single product, management would need to assess the risks associated with that concentration and whether diversification is feasible. Advisors conduct a more detailed financial analysis at this stage, looking into historical performance, growth projections, and potential integration costs. They assess each target's financial attractiveness, helping to refine the valuation and understand the financial impact of the acquisition on the buyer's overall portfolio. We come now to the approach strategy. Deciding how to approach potential targets is a critical step. Management must consider whether to engage directly with the target, use intermediaries, or make a public expression of interest. The approach strategy depends on the target's ownership structure and openness to acquisition. For publicly traded companies, a formal offer might be the best approach, while for private companies, a more personal engagement might be effective. Advisors leverage their relationships and negotiation experience to facilitate initial contact. They might help craft a non-binding offer or expression of interest to gauge the target's receptivity. This step is crucial in setting the tone for future negotiations and ensuring that both parties are on the same page. The next step is the preliminary engagement. Once contact is established, management engages in preliminary discussions with potential targets. These discussions aim to assess mutual interests, strategic alignment, and cultural fit. Often these conversations are conducted under a confidentiality agreement to protect sensitive information. During these discussions, management might explore how the target's employees and customers would react to the acquisition, as well as potential challenges in integrating the two companies. Advisors support these discussions by providing due diligence checklists, preliminary valuations, and strategic rationale. Their goal is to persuade the target of the benefits of the acquisition and address any concerns that may arise. The next stage is prioritization and selection. Based on the information gathered and the interactions with potential targets, management prioritizes the targets. The final selection is based on strategic fit, financial criteria, and the likelihood of a successful acquisition. If two companies are equally attractive financially, the decision might come down to which one offers better cultural alignment or stronger potential for synergy. Advisors assist in this final evaluation, offering insights into negotiation strategies, potential deal structures, and regulatory considerations. Their role is to help management select the most suitable targets and prepare for the next stage of the acquisition process. The target identification process is iterative and dynamic. It may require adjustments to the criteria and approach based on market feedback and emerging opportunities. Effective communication between the buying company's management and advisors is crucial throughout this process to ensure that the search remains focused and aligned with the company's strategic objectives. By the way, if you're serious about mastering the art of M&A, check out my Udemy course on mergers and acquisitions. It's packed with actionable insights and practical examples that will elevate your M&A game to the next level. I'll put a link in the description below. Now, as promised, here's that bonus strategy. One of the most powerful tools you can use in the target identification process is trend analysis. By staying ahead of industry trends and anticipating market shifts, you can identify targets that are poised for growth, long before they become attractive to your competitors. This proactive approach can give you a significant edge in the competitive M&A landscape. If you found this deep dive into target identification valuable, don't forget to subscribe and hit the like button. Your support helps me to continue to create content that empowers you in your M&A journey. And don't miss our next video in this series, where we'll cover the sell-side preparation. You'll learn how to effectively position your company for a successful sale. So make sure to check it out. Thanks for watching this video, and I look forward to seeing you in the next one.